January 9th, 2026. Mark this date. Because what happened in silver markets today was not what they told you it was. The headlines say silver collapsed to $77. Profit taking. Technical correction. End of the rally. But while mainstream media publishes bearish narratives, the largest financial institutions in America are making moves that tell a completely different story. Bank of America just raised their 12-month silver target to $65. That is a 40% increase from current levels. JP Morgan, the bank that paid hundreds of millions in fines for silver manipulation, is now financing the Pentagon's first major silver processing facility in 50 years, $7.4 billion. Scotia Bank, Credit Suisse, Goldman Sachs, these are institutions that fought silver's rise for decades, and they are all publishing bullish forecasts, all of them, simultaneously. This is not random, this is a coordinated pivot, and it is happening at the exact moment silver dropped from $80 to $77. The banks are flipping, not gradually, not quietly, all at once. And the massive market shift that this represents is not in the headlines. It is in the data. It is in their actions. And I'm going to show you exactly what is happening and why the next 6 months will determine who understands this market and who gets left behind. Let me be extremely clear about what just occurred. Silver did not drop from $80 to $77 because fundamentals changed. The supply deficit that drove prices from $30 to $80 is still real. The industrial demand from solar panels, electric vehicles, and artificial intelligence data centers has not disappeared. The Chinese export restrictions that cut 70% of refined silver supply are still in effect. The Pentagon's $7.4 billion smelter project is still under construction. Nothing that justified $80 silver last week has changed this week. The only thing that changed is the price on your screen. And that price was pushed down deliberately to trigger stop losses, force margin liquidations, and shake weak hands out of winning positions before the next explosive move higher. This is the playbook. This is how institutional money operates. They identify assets with genuine supply shortages and structural demand growth. They accumulate quietly at low prices. Then they push the price higher to attract retail attention. Once retail is fully positioned and euphoric, they engineer a sharp correction that triggers panic selling. And while retail capitulates, institutions buy back everything at discounted prices. This cycle has repeated in every major commodity market throughout history. And silver is experiencing it right now in real time. If you sold on January 9th because the headlines scared you, you handed your metal to the smartest players in the market. And they are laughing all the way to the vault. Now let me show you what is really happening beneath the surface. Silver's journey in 2025 was not random. It was the culmination of forces that had been building for 40 years. Since 1980, silver had been trapped below $50 per ounce. Not because of supply and demand fundamentals, not because industrial uses declined, but because the paper market controlled pricing. Banks could suppress silver by selling unlimited futures contracts with no intention of delivering physical metal. They created artificial supply on exchanges that did not exist in the real world, and this manipulation kept silver artificially cheap for 4 decades. But in 2025, something broke. Silver started the year at $30. Boring, predictable, stable. By March, it was at $36, respectable but not extraordinary. Then summer arrived. August 14th, silver broke through 38. This was significant because it marked the beginning of a psychological shift. Traders who had watched silver fail at $50 for their entire careers started questioning the old pattern. Maybe this time was different. Maybe the fundamentals had finally overwhelmed the manipulation. September brought consolidation. Markets paused. Some took profits. Others added positions. The uncertainty was palpable. Then October 17th happened. Silver exploded through $54.60. The 40-year ceiling shattered. For the first time since 1980, silver was trading in genuinely new territory. The old pattern was dead. Something new had begun. The rally did not stop at 54. By December, following Federal Reserve interest rate cuts, silver pushed through $64, then $70. By year-end, it was trading in the 71 to 72 range. The third quarter close told the most important story. Silver closed Q3 at $46.64. This was the highest quarterly close in silver's recorded history. Not a daily spike, not a momentary peak, a sustained, confirmed quarterly close. That number represented something profound. It meant institutions were holding silver at elevated prices. It meant pension funds, sovereign wealth funds, and major banks believed these prices were justified. The paper market had lost control. Physical reality was asserting itself. The supply deficit became undeniable. For 5 consecutive years, the world consumed more silver than it produced. In 2025 alone, the deficit reached 63.4 million ounces. This was not a temporary disruption. This was structural. Mine supply was falling because most silver comes as a byproduct of mining for zinc, lead, or gold. When silver prices rise, these mines do not automatically produce more silver. They are limited by their primary metal. Meanwhile, demand was exploding from directions nobody predicted 5 years ago. Solar panel manufacturing became the single largest industrial consumer of silver. The global renewable energy transition required billions of panels annually. Each panel needed silver paste for photovoltaic cells. There was no adequate substitute. Silicon-based solar technology was fundamentally dependent on silver. Electric vehicles multiplied silver demand. A traditional car used 15 to 28 grams of silver. An electric vehicle used 25 to 50 grams. Some luxury EVs used over 100 grams. As the world shifted from gasoline to electric, silver requirements grew exponentially. Then came the artificial intelligence boom. Every AI model required massive data centers. Every data center needed thousands of servers. Every server required silver for connections, switches, and thermal management. The AI infrastructure build-out of 2024 and 2025 created silver demand that had not existed in any economic model. The United States government recognized this strategic reality. In 2025, they officially designated silver as a critical mineral, not a precious metal, not an investment, a strategic resource essential for national security and economic competitiveness. This was not symbolic. It meant government policy would prioritize silver availability. It meant potential export restrictions. It meant silver had transformed from a speculative commodity into a strategic asset that nations would compete to control. But the most revealing signal came from China. The Shanghai Futures Exchange reported inventory levels in late 2025 that shocked experienced traders. Their silver stockpiles had collapsed to the lowest level since 2015. Physical silver was disappearing from vaults. Lease rates spiked. Borrowing costs increased. These were not paper market signals. This was real metal moving from sellers to buyers who had no intention of returning it. Someone in China was accumulating massive quantities of physical silver, and they were willing to pay premium prices to secure supply. This was not speculation. This was strategic accumulation. The same pattern Russia had pioneered when they announced a $535 million silver purchase for strategic reserves. Russia had set the precedent. Central banks could hold silver, and if Russia could designate it as a reserve asset, other nations would follow. Chinese industrial demand explained part of the accumulation. China dominated global solar panel production. More than 80% of the world's panels came from Chinese factories. As China expanded domestic renewable capacity and exported panels globally, their silver consumption grew exponentially. Chinese electric vehicle production told a similar story. China manufactured more EVs than any other nation by a massive margin. Every vehicle required silver. As production climbed from millions to tens of millions annually, the requirements became staggering. But industrial demand alone did not explain the inventory depletion. Something more strategic was occurring. China had long expressed concerns about dollar dominance in global trade. They had gradually diversified foreign exchange reserves, adding gold and other assets, but they had never significantly accumulated silver until now. The pattern was unmistakable. Consistent buying, declining inventories, rising lease rates, physical shortages, the fingerprints of large-scale strategic accumulation. The gold-to-silver ratio provided insight into Chinese thinking. Historically, this ratio fluctuated between 40 to 1 and 80 to 1. Recently, it had climbed to 90 to 1 or higher, suggesting silver was dramatically undervalued relative to gold. Chinese analysts understood mean reversion. Extreme ratios eventually corrected. If the ratio returned to 60 to 1 and gold prices remained strong, silver would have to rise dramatically. The production ratio was even more compelling. For every 9 ounces of silver mined globally, approximately 1 ounce of gold was produced. The mining ratio was 9 to 1. Yet the pricing ratio was 80 to 1 or higher. This disconnect suggested silver was fundamentally undervalued. Chinese financial journals had published extensive analysis arguing that if silver were priced according to production scarcity and gold traded at $2,000 per ounce, silver should be worth over $200 per ounce, not 70 or 80. This created the framework for understanding January 9th. While American institutions published conflicting forecasts, Bank of America predicting $65, Scotia Bank forecasting a collapse to 33, other analysts suggesting 100 or even 175, China was not making predictions. China was executing a plan. They were not debating price targets. They were accumulating physical metal, less talking, more action. And this created a fundamental split in global silver markets. The paper market, where contracts traded electronically based on financial factors. And the physical market, where actual metal moved from sellers to long-term holders. China operated in the physical market. America dominated the paper market. And increasingly, these two markets were telling different stories. The January 9th price drop reflected paper market dynamics. Technical selling, profit-taking, stop-loss triggers, dollar strength. All the usual suspects that financial media could point to as explanations. But beneath the surface, physical demand from China remained relentless. This was the disconnect. Paper prices were falling. Physical metal was disappearing. One of these markets would eventually force the other to adjust. The question was, which would break first? History provided the answer. Paper markets always break when confronted by physical scarcity. You cannot deliver contracts that require metal you do not have. And the COMEX, the primary silver futures exchange in New York, was running dangerously low on registered inventory, the metal available for delivery against contracts. COMEX registered inventory had been falling steadily throughout 2025. By January 2026, it stood at approximately 90 million ounces. That sounds like a lot until you compare it to open interest, the number of contracts that could theoretically demand delivery. Open interest represented over 600 million ounces. If even 15% of contract holders demanded physical delivery, the exchange would default. It would run out of metal. This was not theoretical. This was mathematical reality. The paper market had created far more claims on silver than physical silver actually existed in deliverable form. And as long as most contracts settled in cash, the system functioned. But the moment significant numbers of buyers demanded actual metal, the entire structure would collapse. China understood this perfectly. They were not buying COMEX futures. They were buying physical metal and removing it from Western vaults. Every ounce that moved from New York or London to Shanghai was one less ounce available to satisfy future delivery demands. This was economic warfare conducted through commodity markets. Drain Western physical inventories, force the paper market to confront its insolvency. And when the inevitable default or force majeure occurred, the price of physical silver would explode as the world realized paper claims were worthless. Physical possession was everything. January 9th was a gift to anyone who understood this dynamic. The price drop created an opportunity to buy physical metal at artificially suppressed prices before the paper market broke. Smart money was not selling into this dip. Smart money was buying aggressively. The Pentagon's involvement added another dimension to the story. On December 15th, 2025, the U.S. Department of Defense signed a $7.4 billion deal with Korea Zinc to build a critical minerals processing facility in Tennessee. This was the first major non-ferrous metal smelter constructed on American soil since the 1970s. For 50 years, America had been content to let China process its metals. But suddenly, in the middle of a silver shortage, Uncle Sam was dropping $7.4 billion to bring processing home. Why? Because Chinese export controls implemented January 1st had cut off Western access to refined silver. And without refined silver, America could not build the weapon systems needed to maintain military dominance. The Pentagon took a 40% equity stake in this facility. They were not just a customer, they were an owner. This meant silver from this smelter would not go to the open market. It would go straight to U.S. military stockpiles. It would be removed from commercial supply before it was even refined. This was resource nationalism. This was what happened when governments panicked about shortages. And if the most powerful military on Earth was panicking about silver supply, what did that tell you about the price trajectory? The facility was designed to process 1.1 million tons of raw material annually, producing 13 specific metals. 11 were listed as critical by the U.S. Geological Survey. Silver topped that list. The government had looked at their stockpiles, looked at Chinese export bans, looked at the Shanghai premium, and panicked. They realized they were vulnerable. They realized that without silver, they could not build missiles, fighter jets, or satellites needed to compete with China. The entity financing this deal was J.P. Morgan, the same J.P. Morgan that had been the biggest silver shorter for 15 years, the same bank that manipulated COMEX futures, spoofed orders, and coordinated with other banks to suppress prices. Why would the biggest short in history suddenly finance the biggest physical infrastructure project in 50 years? Because they knew the game had changed. They knew the paper market was dying. They knew that in a world of physical shortages, holding short positions was financial suicide. So they pivoted. They moved from paper manipulation to physical control. They positioned themselves to own the flow of silver from Latin American mines to Pentagon stockpiles. They were admitting with their actions, not their words, that the era of paper was over. Physical was king. Now let me connect all of this to what happens next. January 9th was not the end of silver's rally. It was an engineered pause before the next explosive leg higher. The dip from $80 to $77 served a specific purpose. Trigger stops, clear weak hands, reset positioning. And now that the reset is complete, the path higher is clear. Technical analysts are watching specific levels, support at $73 and $75, resistance at $82 and $85, but these technical details mask the bigger truth. Silver broke a 40-year pattern in 2025. It is not going back to $30. The only question is how high and how fast. Bank of America raised their 12-month target to $65. That forecast is already obsolete because silver traded above 70 for most of December. But the fact that a conservative institution like Bank of America went bullish at all is significant. They saw something in the data that convinced them higher prices were justified. Other analysts were more aggressive. Keith Neumeyer from First Majestic Silver had been predicting $100 to $130 for years. His supporters wore shirts that said triple-digit silver. Critics called them dreamers. But then Alan Hibbert from Goldstock went even further. He predicted silver would perform better in 2026 than it did in 2025, better than 147%. He stated publicly he would not be surprised to see silver reach $175 or higher. These were not random guesses. These were forecasts based on supply-demand fundamentals that had never been more bullish. The 5-year deficit, the industrial demand surge, the government resource nationalism, the Chinese accumulation, the COMEX inventory depletion, all of it pointed in one direction, higher. The disagreement among analysts was not whether silver would rise. It was how high. Some saw 100 as realistic, others projected 175. A smaller group of technical analysts looked at the 40-year cup and handle pattern and calculated targets between $250 and $300. They acknowledged these numbers sounded insane, but they pointed to the pattern mathematics and insisted the projection was valid. The Federal Reserve controlled the immediate catalyst. Interest rate decisions directly affected silver through multiple channels. Lower rates weakened the dollar. A weaker dollar made silver cheaper for foreign buyers. Lower rates also reduced opportunity cost of holding silver, which paid no interest. When bonds paid 5%, investors hesitated on silver. When bonds paid 2%, silver became more attractive. The Fed had cut rates in late 2025, helping push silver to December highs. Now, in early January, markets priced in over 80% probability the Fed would hold rates steady. But Fed Governor Moran had complicated matters with recent comments suggesting aggressive cuts might be needed. His words created uncertainty. Would the Fed cut? Would they hold? Nobody knew for certain. Meanwhile, the Fed's balance sheet was expanding through the reverse repo program. Technically, this was just liquidity management. The Fed insisted it was not quantitative easing, but many analysts saw it as stealth money printing. More dollars in the system, more liquidity, more inflation pressure. And all of that supported commodity prices, especially precious metals. The dollar index had fallen below 99. Treasury yields hovered around 4.6%. Inflation remained above the Fed's 2% target. Not dramatically above, but persistently above. And that persistent inflation was changing investor behavior. People who trusted cash and bonds were reconsidering. Precious metals were getting a second look. Physical demand signals were everywhere. American mint operations reported shortages in silver bars and coins. Retail investors wanted actual metal, not paper claims. This created premium pricing. Physical silver traded above spot because supply was tight. Dealers could not maintain inventory. Wait times stretched from days to weeks. Some products were unavailable at any price. This was the real market speaking, not the paper market with its infinite contracts. The physical market with its limited supply, and the physical market was screaming scarcity. The contrast between paper and physical could not be more stark. Paper silver suggested liquidity and easy trading. Physical silver suggested hoarding and shortage. One of these markets was lying, and history had proven repeatedly that physical reality always wins. So what should you do right now? First, understand that January 9th was not a fundamental change. It was a technical manipulation. The forces driving silver higher have not weakened. They have intensified. Chinese buying continues. Pentagon construction proceeds. Industrial demand grows. Supply deficit persists. COMEX inventory depletes. Every fundamental that justified $80 last week still justifies it today. Second, recognize that price dips in a bull market are opportunities, not warnings. Strong trends do not move in straight lines. They advance, pause, consolidate, then advance again. Each pullback shakes out weak holders and allows strong hands to accumulate. That is healthy. That creates the foundation for the next leg higher. Third, prioritize physical over paper. Do not hold silver through ETFs or unallocated accounts if you can avoid it. Get actual metal in your possession or in allocated storage where you have legal title. The counterparty risk in paper silver is enormous. When COMEX defaults or declares force majeure, paper claims will be settled in cash at prices that do not reflect physical scarcity. Physical holders will be protected, paper holders will not. Fourth, ignore short-term noise. The financial media will publish bearish headlines. Analysts will call tops. Technical traders will identify resistance levels. None of that matters if you understand the strategic forces in play. China is not day trading silver. They are implementing multi-decade plans. The Pentagon is not speculating. They are securing supply chains for national defense. These are not players who panic at 5% corrections. Fifth, watch the $85 level. When silver breaks convincingly above 85, the next wave begins. Algorithms flip bullish, shorts scramble to cover, retail FOMO kicks in, the buying pressure overwhelms selling and propels price vertical. From 85 to 100 could happen in days, not weeks. From 100 to 120 could be equally fast. Momentum accelerates as it rises because short covering intensifies. Sixth, understand that you are not gambling. You are positioning on the same side as the smartest institutions on Earth. The Pentagon is securing silver. China is accumulating silver. JP Morgan is financing silver infrastructure. These entities do not make mistakes at this scale. They see what is coming. They are preparing. And you can prepare alongside them by holding physical metal. The window is closing, not because the rally is over, but because physical availability is declining. Every month that passes, premiums increase, wait times lengthen, inventory disappears. The time to position is before the crowd realizes what is happening, before mainstream media starts covering silver shortages, before your neighbor asks if you own any. By that point, premiums will be 50% over spot. Products will be back ordered for months, and the easy opportunity will have passed. January 9th gave you a gift, a manufactured dip that created one more chance to buy at reasonable premiums before the next wave. Do not waste it. Silver at $77 in a world where China is hoarding it, where the Pentagon is spending billions to secure it, where industrial demand exceeds supply, where COMEX is running out of inventory, where analysts are forecasting 100 to 175. This is not expensive. This is the opportunity, not because I say so, because the fundamentals say so, because the institutions positioning with billions of dollars say so, because the mathematics of supply deficits and structural demand say so. The great reset that people have discussed for years is not coming. It is here. It is happening right now. The monetary system built on unlimited fiat currency is colliding with the physical reality of finite resources. And in that collision, real assets with no counterparty risk are going to preserve wealth while paper claims evaporate. Silver is the most undervalued strategic asset on Earth. It is essential for every major technology of the 21st century. It is in permanent deficit. It is being weaponized by nations who understand that control of critical materials is control of the future. And it is trading at prices that will be remembered as the buying opportunity of a generation. January 9th was not a collapse. It was a reset, a repositioning, a gift. The question is not whether you believe silver is going higher. The question is whether you will act on that belief before it is too late. The institutions have already decided. They are buying. The question is, are you?